The SharePickers Podcast.
And joining me on the podcast right now and live on video. I said live, it's not live, it looks live. We are lively.
We're trying to be.
We're trying to be as alive as we can. In fact, the market seems to be picking up a bit. They seem to be livening up a little bit. And you did mention there the AIM All Share, and we'll look at the markets. But Russ Mould, here, Investment Director at Stockbroker AJ Bell.
Good day.
How's it going, Russ? You all right?
I'm all right. Justin, you okay, mate?
Yeah, it's freezing down here at the moment.
Yeah, it's chilly in Brighton, I can assure you. If I was talking to you, I'd have a jumper on, I can assure you, but I've smartened myself up, especially for the occasion.
Yeah, this doesn't look like a big thing, but I did post this out yesterday on X.
Yeah, I saw it.
Called. And I said, if you look at that, so the day yesterday, I moved that a bit. The day yesterday, 1.19% up. And last time I had a big day like that was back in December, which is a nice rally after that as well. So are we seeing, and you can see this technical bounce, massively oversold for how many years? So September 2021, it's been down all the way, and it hasn't broken this 200-day moving average for a long time or finished above it. Now it's done it a few times, and it's above it now. And so I'm thinking we may have seen a bottom down here back in October. And I don't know what your thoughts are on the macro scene, Russ. Or
it'd be lovely to think so. I mean, it's interesting. I think the Russell 2000 is trying a bit of a catch-up in the USA as well, having lagged the S&P 500 and the Dow and the NASDAQ for some time. So I know that an American idea of a small cap is a lot bigger than the British idea of a small cap, but that's kind of the main US small cap index, and that's having a bit of a run as well. And with Treasury yields going up and Treasury prices falling, or government bond yields going up and government bond yields falling, and commodity prices going up, we'll come back to that in a second, and small cap showing on a bit of a spurt as well. We may be getting a bit of a reappraisal. We've talked about this before. In 2022, the consensus view was there would be a recession. Didn't happen. 2023, the consensus view was you'd get a cooling in inflation and a soft landing in interest rate cuts. Well, we certainly didn't get the interest rate cuts. And in 2024, the similar narrative is still out there, and we still haven't had the interest rate cuts. So, and if anything, the American economy is now proving stronger than everybody expected rather than weaker. And even the UK numbers have been suggestive that the recession that we had last year would be potentially shallow and short. And German industrial production figures this week have been very good. So it just feels as if the narrative's slightly moving away from that recession we've all been terrified of, towards maybe stronger growth, halter inflation, and heaven forbid, maybe interest rates higher for longer. I mean, there are lots of moving parts there, but it just feels as if, again, surprise, surprise, the consensus narrative priced in might not necessarily have been the right one. And small caps, a bit of a resurgence in small caps would fit with that, because they generally tend to be more sensitive to their local economy. So if they're doing well, that can be a decent sign, economically speaking, at least.
Yeah. So you're right there. And the thing is, it does seem like we are, like I say, we move with the American markets. Whenever they move, we move, and it's the issue. I mean, there's a lot of talk about, in fact, I was wondering why the rally happened yesterday. Was it because it seems like German industrial figures were quite good, and of course, biggest economy in Europe. Was that why you think everything sort of moved positively yesterday?
Yeah. I mean, I guess we all tend to look for narratives to explain something after it's happened, and that's one that's been plucked out of the air. The other one is you've seen the iron ore price pick up a bit of steam this week, and that's been put down to China looking better than people expected. So, I mean, that again seems to be the currency view. And again, just going back to our last two conversations on commodities, if you have a look at the top 10 performers in the FTSE 100 today as we speak.
Yeah, well, let's get them up there.
I reckon there's at least 8 commodity stocks in there again.
Oh yeah, look at that. There's Anglo American, Rio Tinto, BP.
All right, 5 or 6. But when I just before we came on air, it was more so. But they're up there. So intriguingly now it's the silver miners that are catching up to the silver price, as we discussed last week. It's currently 65. The gold price is currently 85 times the silver price, when the long-term average is 65. So gold's going up. People are now looking at silver. But just to go back to
gold and silver, look at that, almost rallying there. So I
mean, again, that looks possibly a bit overcooked in the short term to me. But I'm not a chartist. But again, it's interesting that people are latching on not just to cocoa and copper and oil, but to gold, silver, and a few other things as well for good measure.
Well, look at that. That's the relative strength index down here, and you can see that they sort of say anything over 70 is getting towards overbought. And what is it at? 84, and you very rarely see any price or share price sustainable when it's at 80 or above 80. It tends to sort of, have to have a comeback or a pullback. But you can see there, it's bounced on that silver, $26.
Yeah, punches through that.
Yeah.
I mean, the all-time high is nearly 48 from 2011 and then 1980. So there's a long way to go there. So.
Oh yeah, look at that, 48 back in 2011. Spot on there. Yeah. But it's gold. Gold is
gold's at an all-time high.
Yeah.
Whereas silver nowhere near. So again, it's not surprising that people are casting around looking for other ways and means in. Intriguingly.
Yeah. Well, I mean, someone did say someone did recommend a fund of. I hold a fund which is the FTSE 350 high yielding stocks, and there's quite a few commodity plays in there.
Yep,
but someone did suggest, I think it's BlackRock's World Mining Fund.
World Gold Mining. Yeah, there's BlackRock's got a couple of world mining and world gold mining funds. Yes, it has for those people. I think that's an appropriate way in.
Yeah, there we are. BlackRock World Mining Trust. Now it's come down a little bit, but it's starting to sort of. You can see here off the bottoms. Since 27th of February, it's come from 490 up to 550 pretty much, and you're starting to see, of course, that's going to have a bit of a lag there. But I think the breakdown in that is mainly copper, gold is the top two sort of commodities. So it's a good play, but it's come down quite a bit. So have you been looking at anything else, Russ? Any stocks, anything at all?
Yeah, just looking at that chart that we went back to right at the start, just looking at a couple of companies, and again. Because I know you're interested in the small, the tiny caps, particularly. I don't know if these are a bit big for you at a couple $100 million, but just
I tend to look. There's a stat behind this. Every year, pretty much, I look at not just the last year, but I tend to look at the last 3 to 5 years best performing stocks. And there's 1,000 odd companies listed in the UK, and it's hard. You can't research. I mean, even a man with a brain of your size would find it hard to be across all those companies. So what I do, I try and focus on companies that I know are going to do well. And so I look at every sort of year and look back at the last 3 years, and you tend to find the best performing stocks start off the market cap below 100 million. They start getting a bit more risky down there because you have to do a lot of due diligence. But if you look at it, some of the best performers of all time, and I'm not talking about pre-revenue stocks, but they all have something in common. One is size, and they're generally below 100 million. Of course, it's 40% above that size, but it's down to logistics and research and time you have to research them. And they all were revenue generating and pretty much had very good top line growth round about multiple years of around about 20% or more.
Oh,
and they've been standard, and they weren't expensive either. They started off. I looked at in fact I got 10 baggers that started below 100 million market cap. And they all had multiple years of top line growth, but they kept their margins, or their margins improved, so that gave them a higher rating pretty much. And but they all started off quite reasonable. And I'm talking about I think of the 10 companies I looked at, the average price to sales was around about 1.2, so it wasn't huge. The highest was 3.3, which I think was ASOS. I think the lowest was 0.07. So the average was quite low, and the median was about 0.58. So they weren't expensive. So you go growth, value, size, and then of course on charts they had momentum. But so if you get growth and value, if you can pair those together, and I know some people say it's either growth or value, but I think Warren Buffett said there's no such thing as growth or value. You've got to have a bit of both.
Exactly. So, if you've got lots of value and no growth, you might as well forget it. So
exactly.
I think tobacco stocks have probably told you for the last last 5 years.
Absolutely,
so the two names I've picked out, and that's your process. My process is a little bit different. And the first thing I always look for is downside protection. So I'm looking for a really healthy balance sheet. I'm looking for some cash generation, or at least I'm looking for some asset backing if I'm dealing with, say, an industry. It is, and because, as you pointed out, AIM stocks have underperformed, small caps have underperformed for what feels like forever. Yeah. You can actually pick up things that are trading at book value or less, or pretty close to their cash pile or less. So one name is Costain, £215 million market cap, and it's got a net cash position, last time I looked, of £194 million.
Nice.
And that's with the pension surplus in there, but lease liabilities. So you're paying 25-30 million pounds for a business that's got 1.3 billion pounds of annual revenues. It's a company that's had its problems. It had 2 horrible contracts. It's a big infrastructure play, and the margins. It's a contractor and consultant, so the margins are quite thin. So if something goes wrong, the profits disappear very quickly, and it actually made losses for 3 years in a row. Those projects are now behind it. There's a new management team. It's had a rights issue to shore up the balance sheet. And now it's starting to win new business. I mean, we've all heard about the Thames water ruckus. Yeah. And how unhappy everybody is with the status of the UK's infrastructure. Well, here you have an infrastructure play that's already pulling in AMP8 water utility regulatory cycle for 2025-30. It's already pulling in orders from United Utilities and others. It's involved in Sizewell C nuclear. It's involved in national highways and rail projects. So it's right in a sweet spot, you could argue, potentially in terms of the business flow. It's going to be lumpy. You're going to have to be patient, but you've got to stock with, very limited downside relative to because of the cash pile. Management team's looking to drive margins up to 5%, which might create some revenue, some profit momentum. It's just returned to the dividend list, and you've got a share price chart that looks like that. So it's one that came up on my screen just because of the cash pile relative to the market cap. Yeah, there you go. I mean, look how badly that's gone, right?
440, pretty much 440 a share back in 2018. It's come all the way down. Wow, look at that, down to 29 pence.
Yeah, and now it's at 60 odd 70p, I think. So
and this is an interesting bit in the chart. You're just looking at that because we had a low here bounce, and you can see it sort of hit from the low. It was 30 pence. It rallied to 44, come back down, broke this 200-day moving average, and then broke up above that level, came back down, tested it, then rebounded, and it bounced again on it. But now it's starting to really motor, and it's used that sort of level, 43, 44 pence, and now it's really motoring up. It's nice, and see a nice bit of air between the 200-day moving average and that. So that's a good-looking chart there. So
what we're waiting for now is, again, you're just waiting for affirmation now that there's some margin progression when the next trading statements come through and a few order wins, and that is potentially something that might go forwards. But again, what caught my eye initially, just from again, this isn't advice, but just from a research process point of view, was cash pile relative to market cap and the downside protection that gave you.
Yeah. Do you know that's when you're looking for stocks, that sort of also when you get sort of revenue growth and margin improvement, that's like twin boosters, because literally not only are you growing the top line, but your margins are getting better. You're chucking more cash to the bottom line, and then you get sort of re-rated. The multiple sort of goes up. So that's a good sign that. But cool. What's that? You said another one?
Hargreaves Services, HSP.
HSP. Okay.
And again, my starting point here was you've got a company with 605 pence a share of net assets on its balance sheet, or so 605p a share of net assets on its balance sheet.
That's good, yeah.
And the share price is what, £5 odd. So again,
181 million market cap. But
again, there's always things that can trip a company up. Again, this is a more complicated one. It's an infrastructure play with mechanical and electrical services to utilities, rail companies, tunneling companies. It's got a brownfield land business here in the UK, which it redevelops the land, sells it on for warehouses, green energy projects, even residential property. And it's got a stake in a German raw material business. So the land sales is lumpy. So again, you've not got an entirely straightforward or visible revenue stream, although the infrastructure business isn't too bad there. But it generates plenty of cash. There's actually quite a fat dividend yield on there. And again, the balance sheet's got virtually zero debt. It's about £4 million. You've got solid asset backing, a decent amount of cash flow, and a share price that was just unloved for a very, very, very long period of time, hence the discount to book value. And again, so it won't take too much, perhaps, for people to maybe take a second look at it.
Yeah. Look at that. It's a heck of a chart there. So a roller coaster coming down, up, down. But it's moved up a little bit here. So you can see previous resistance broken up there and moving higher. I'll show you what. I'll show you something.
There you go.
This is my website, right? So I do a MicroCap League. So I literally rank all these companies by growth, value, health, efficiency, momentum. There's one on there called Hercules, and it's the same space as those guys. Hercules site. So you click in there, and they are a leading tech-enabled labour supply company for the UK infrastructure sector, founded in 2008. But you can see here, share price, target upside, there's a broker target there, the market cap, enterprise value. Obviously, they must have a little bit of debt because enterprise value is below that, so 9.9. But then I break it down into a half year, full year. I look at 4 or 5 growth metrics, 5 value metrics, and as you can see there, revenue growth is very good. It's very good. Look at the value, your price of sales, price to earnings, price to book, all that. I look at the health, okay, they got net debt there. And in fact, when's the last set of results? Was it the 31st? So this is the more recent side. So it has come down a little bit, the debt, but it's still, the gross gearing is 115. So think, okay, that's not so good. And then you got momentum there in the chart there and the broker forecast there. And I break it down into the balance sheet and all that, so my forecast there. But, yeah. So, but you find these companies, like you say there, there's a little bit of worry about having small margins. And in fact, what was the margins on this? Because efficiency, margins, gross is sub 20. So operating is 2.4.
Fairly skinny. So again, you need
and return on capital employed is 9.23. But they color code depending. I generally go 40 is green. Above 10% return on capital employed is green. But so that's I literally go through it every day. Anytime the results come out, on our MicroCap, I plug them into the back end there, and it comes up all this, and you can sort of compare them and rank them from 1 to 100. So it's a nice sort of clear way of looking at it.
Good. It's all about having a process and sticking to it and sticking to your disciplines and not giving into fear of missing out if something comes up.
That's it.
And I think that's what it can feel good at the time, but there can be a lot of buyer's remorse. And even if you get it right, and you pile into something that you don't feel is normally you, but it's going around. The key question you've still got to face is, when do you sell? How many people sold GameStop at the top? Obviously somebody did, because somebody bought at the top, right? But not many. And I'd be frightened to wonder how many people are still clinging on in there, having bought an awful lot higher than we are now. Because, all right, they maybe did something they wouldn't do normally, but they piled in, it rode it, but then didn't have a discipline as to when they would sell and actually lock in the profit. And that's the whole secret to it in the end. Yeah,
exactly. And do you know what I also do? So on my section is portfolio management, and I talk about funds and individual companies. And most private investors lose money investing in individual companies. It's very risky, of course, because it can be very volatile. You've got to do a lot of research. So it's a lot easier to invest in a fund. And over the time, if you sort of dollar cost average and say there's a high probability, 5-10 years, you will make money in a fund.
That's the thing, it's a long-term perspective.
But when you're investing in individual stocks, you've got to have a sort of portfolio management. And, if you're looking at a fund generating if you're 5 and 10% a year, if you're going into individual stocks, you need to be beating that. And so it can be quite hard. So I get the stage when I try to, if I'm disciplined enough, normally, if I get sort of 20% up, I'll automatically put a stop loss in my buy price. Because then I've got pretty much a risk-free investment. And one of the biggest things, if you can't lose on an investment, then you can only sort of break even. And so one of those things. And then it starts going any further, anything. But if you start getting above 20% or where your fund is returning you, then it's worth you investing in individual stocks. If you can't beat your fund, you may as well stick to your fund. So it's always worth, because people do that. Today, actually, a company came out, Broken Note came out, a company, and they give a massive target. And I thought, I can't really see it. So, because they're loss making, and there's lots of forecasts. And forecasts are like the weather forecasts. And the further they are there, the less accurate they are. And I thought, I can't really see the upside here at all. And it started rallying about 10%. I don't know if it was a Broken Note or what. And I thought, I've been watching it for a while. I said, jump in. And I thought, no, I can't. I have to stick to. I can't. I can see maybe growth happening, but I can't see the value being good at the moment. So I thought I'll let it go. But sometimes,
and with a lot of those broker comments, with a lot of those broker comments now, you've got so many algorithms scraping the internet looking for data, and then trying to provide an actionable response for the fund that they're contributing to. You will get a note come out positive. The algos will see the positive comment, and they'll come in for the stock. And if it's not very big, it's not very liquid, there's a wide spread, the share price will move. But again, I wouldn't. This isn't advice, but if you see that, see somebody, stock up on broker comment, A, think about, is the broker advisor to the stock? The answer is there's a fair chance it is, so consider the source. And B, just think about now the role of algos in the wider market as they scrape around for all of that data and act on it very quickly. You will be seeing stuff that's probably driven more by machine than humans, and if you want to follow that, that's entirely up to you. But you need to backtest that as part of your process and still have a discipline at some stage. When you want to lock in your profits, because there's no point holding everything forever and falling in love with it, because no matter how much you love your football team or rugby team, they don't play any better every week, do they? So you've got to be very very cold and calculating about this.
Well, this what you're talking about there is the discipline. It's very important, because I set myself many rules. How many times do I break them? Quite a lot.
Because we're all human. We all do.
It's that emotional thing, that pulling the trigger on something. It doesn't really fit my thesis at all. And but you just jump in sometimes. You make a mistake. And some of the best things you can do there is always start small. If you're going to invest in something, don't go big. Because if you make a mistake, it'll be a small mistake. But you learn from it. And it is funny, isn't it? Psychology investing. That's why I love it so much. It's like maybe algos and AI could do better because it's got no emotion at all, So that's the problem with the downfall of humans, isn't it? Too much emotion involved,
But again, if the data is easily scrapable, I don't think there's a massive edge there anymore. So again, I think I think it's things that you can almost researching things that the machines don't or can't. I think that's really what you've got to be looking for to some degree. But again, that's if you're probably trading in the very short. Over the long term, just stick to the disciplines. The fundamentals will out and just cut out the short term noise. Yeah,
exactly. And as regards return, I mean, people, tend to go for, I see a lot of people going for trading these sort of pre-revenue stocks that can go up by 50% and down by 40% next day. I'm thinking, in the end, it's a false economy. The best performers are generally, revenue generating stocks over the long term. They're growing, they're getting better, they're generating more cash. And you've got to sit down and think, okay, what kind of return are you happy with? Because if you're beating your fund, for example, let's say if you do 20% on most investments, 20% compound annual growth adds up to a heck of a lot, over 5, 10, 20 years. And
7% a year, you've doubled in 10 years' time. So, I mean, that sounds pretty good to me. Yeah,
exactly. And I think, is it Warren Buffett? I think he's done around about 22% compound annual growth. And a lot of that was because of Apple, so he earned so much money from
in
Apple.
Recent times, yeah.
Yeah. Marvellous stuff. Russ,
Pleasure.
Thanks for that. Always good as always. And
good to see
we'll
you.
Catch up next week, fella. Cheers.
The SharePickers Podcast with Justin Waite. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.